I'm Mike Larson with Money and Markets TV. A hilarious thing happened earlier this month. The president of the New York Fed, William Dudley, tried to justify the Federal Reserve's easy money policy. In a speech before the Queen's Chamber of Commerce, he claimed that inflation isn't a problem because, quote, you can buy an iPad 2 that costs the same as an iPad 1. You have to look at the prices of all things, he said. A response from the crowd? Utter disbelief. One person referenced the rampant food inflation by asking Dudley, when was the last time you went grocery shopping? And another yelled, you can't eat an iPod. Me? I can't believe the claptrap the Fed's peddling either. Former Goldman Sachs economists like Dudley and his Ivy League educated boss Ben Bernanke may say, at least publicly, that inflation's under control. But the rest of us in the real world know that's bupkis. Gas, food, college tuition, heck, even Diet Coke. It's all getting more expensive. More important, the official data now confirm what you and I are seeing every day. The 3 monthly inflation gauges are all rising. First, import prices jumped 1.4% last month over January's level. That easily topped forecasts, and it was the 5th straight month that prices rose by more than 1%. On a year-over-year basis, imports cost 6.9% more than they did last February, the fastest inflation rate in 9 months. And get this, the price of imported food shot up by the most since the government began tracking the data in 1977. Meanwhile, producer prices surged 1.6%, the biggest monthly gain since June of 2009, and wholesale goods and services now cost 5.6% more than they did a year ago. Further up the pipeline, intermediate goods rose by the most since July of 2008, while the price of crude goods surged another 3.4%. And as we all know, inflation is now hitting consumer prices too. They jumped by 0.5%, the most in 20 months. In addition, the core consumer price index, which excludes those food and energy costs that the Fed apparently doesn't pay, has risen by 0.2% for 2 months in a row, something we haven't seen since the fall of 2009. Folks, this isn't just a US phenomenon either. We're seeing inflation surge in the UK and the Eurozone as well. Central bankers in all 3 regions have had their heads in the sand for a while now. But all this troubling inflation data is turning up the heat, and the Fed's counterparts across the Atlantic are starting to pay attention. Investors are now speculating that the European Central Bank will hike interest rates as soon as next month, while the Bank of England won't be far behind in July. But of course, here in the US, Bernanke is still dragging his feet. Despite his protests, though, the yield curve is continuing to flatten as I predicted several weeks ago, and investors actually continue to bet against Bernanke in the interest rate futures market. So why is this important to you? For one, as slightly tighter monetary conditions get priced into the market, I wouldn't be surprised to see risky assets like stocks get hit. I also continue to believe the dollar is vulnerable. So my advice would be to use the relief rally we've seen in the wake of the Japanese earthquake and nuclear crisis to lighten up on stock market risk. I'd also hedge your currency risk that you may have in your fixed income portfolio by using investments such as the iShares S&P Citigroup 1 to 3 year International Treasury Bond Fund. I know it's a mouthful, but just remember the ticker symbol ISHG. That ETF owns foreign bonds, which tend to rise in value when the dollar falls. Oh, and if a Fed official shows up in your town to talk policy, feel free to heckle them all you want. These guys don't know what they're talking about when it comes to inflation. I'm Mike Larson for Money and Markets TV. Thanks for watching.